NIO stock has finally slipped below the $6 mark, closing Friday session at $5.95. For weeks, that $6 level had been something of a psychological anchor, a line in the sand that traders and long-term investors alike were watching closely. And while the breach below it doesn't mean the NIO story is broken, it does carry symbolic weight. It tells us that the market is re-evaluating the company in real time, weighing the risks and opportunities more carefully. So, what exactly happened on Friday? Let's start with the trading action. NIO opened at $6.20, managed a quick touch-up to $6.22, but couldn't hold momentum. From there, the stock drifted lower, hitting an intraday low of $5.92 before finishing at $5.95. That represents a drop of nearly 3% on the day, and it capped a week where the stock declined 3 sessions in a row. Now, the volume number is interesting. Only about 59 million shares traded hands, which is well below the 50-day average volume of 74 million. When a stock breaks through a key support level like $6, and it happens on lighter-than-average volume, that can be interpreted 2 ways. Bears will say it shows a lack of buying support, that the conviction among bulls just isn't there. But optimists will argue that if this were a real panic, if investors were truly rushing for the exits, we would have seen a much larger spike in volume. Instead, this looks more like hesitation, or maybe fatigue, rather than outright fear. We also need to put Friday's move into context with the broader market. The Dow Jones fell about 0.5%, the Nasdaq slipped slightly, and investor sentiment across the board was tepid. In other words, this wasn't just a NIO-specific sell-off. Chinese stocks as a group were under pressure, with names like Alibaba and Baidu also trending lower. Anytime macro sentiment turns cautious, NIO tends to feel it harder because it sits at the intersection of 2 very sensitive themes. It's both a high-growth EV play and a Chinese equity. That means it carries extra risk premium in the eyes of global investors. Now let's zoom out from the daily chart and talk fundamentals, because this is where the NIO story actually looks much more promising than the short-term price action might suggest. Earlier this week, NIO reported second-quarter results that beat Wall Street's expectations. Revenue came in at $2.7 billion, versus about $2.4 billion a year ago. Operating losses narrowed to around $567 million, which was significantly better than the $620 million that analysts had projected. Gross profit margin ticked higher as well, to 10% compared to 9.7% a year earlier. That might not sound like much, but in the hyper-competitive world of electric vehicles, where price wars are squeezing nearly everyone, any improvement in margins is a win. Tesla has been cutting prices aggressively, BYD has been moving volume, and newer entrants like Xiaomi are pushing into the market. For NIO to show even a modest margin gain in that environment is an encouraging signal of operational discipline. Deliveries are another major bright spot. NIO delivered over 72,000 vehicles in the second quarter, a 26% year-over-year increase. And the company really turned heads with its August delivery numbers, 31,305 vehicles delivered, which was a record for NIO and a 55% increase from August last year. Those numbers don't just reflect production efficiency, they reflect genuine demand for NIO's lineup, particularly the new Onvo L90 SUV and the continued strength of the Firefly brand. There is, however, a trade-off to this success. Average selling prices have come down. A year ago, the average NIO vehicle was selling for around $38,000. Today, that figure is closer to $31,000. That decline reflects the price war that's raging in China's EV sector. But here's the counterbalance. NIO is offsetting lower prices with higher volumes. The strategy here is about scaling, get more cars on the road, build brand loyalty, increase factory utilization, and then leverage that scale to improve profitability down the line. It's not a short-term profit grab, but a long-term positioning strategy. And while we're on the subject of long-term positioning, we have to talk about NIO's battery swap infrastructure. This is one of the most distinctive things about the company. While most automakers are focusing solely on charging networks, NIO has gone all in on battery swapping. The idea is simple. Instead of waiting half an hour or longer for your EV to charge, you can pull into a station, swap your depleted battery for a fully charged one, and be back on the road in minutes. For drivers, that's convenience. For NIO, it's also recurring revenue, since many customers subscribe to battery-as-a-service plans. Building out this ecosystem takes time and money, but it's a differentiator that could pay off massively in the future if the concept continues to gain traction. So, the big question, where does the stock go from here? Analyst sentiment gives us some clues. Citi has reiterated a buy rating with a price target of $8.10, pointing to expected improvements in profit margins and cash flow in the coming quarters. Bank of America Securities is also constructive, with a target of $7.10, citing confidence in the strength of NIO's product lineup. Even Freedom Capital Markets, which downgraded NIO from buy to hold, raised its target from $4.90 to $6.50, acknowledging the progress the company has made. That tells us something important. Even the cautious voices aren't calling for collapse. Instead, they're adjusting expectations upward, albeit modestly. That's consistent with the idea that NIO's fundamentals are improving even as the stock price struggles in the short term. Looking ahead, NIO has guided for about 89,000 deliveries in the third quarter. If they can hit or beat that figure, it will cement the narrative that the company is scaling aggressively and capturing more market share despite competitive pressures. A strong September delivery update could be the catalyst that pushes the stock back above $6 and reignites momentum. Of course, we can't ignore the risks. The Chinese EV market is arguably the most competitive in the world. Tesla, BYD, XPeng, Li Auto, and Xiaomi are all fighting for share, and price wars are brutal on profitability. Add to that the reality that government tax breaks and incentives are starting to fade, and you've got a sector where survival will depend on execution and efficiency. NIO's CEO himself has warned that the industry faces a major test as these subsidies wind down. That honesty is refreshing, but it also highlights the stakes. Another risk is macroeconomic. China's economy has been slowing, and consumer demand is not as robust as it once was. For a company like NIO, which is still working its way toward profitability, weaker consumer sentiment could put pressure on sales volumes. Add in global investor skepticism around Chinese equities, and it's clear why volatility is such a constant companion for this stock. So, how should investors interpret Friday's break below $6? In my view, it's a setback, but not a disaster. It's a reminder that stocks rarely move in straight lines. After rallying more than 40% earlier this year, NIO was due for some turbulence. The fundamentals haven't changed dramatically in the last 48 hours. Deliveries are still growing, losses are still narrowing, and margins are still improving. The story is intact. What shifted is sentiment, and sentiment can turn back just as quickly as it soured. For long-term investors, this dip might actually represent an opportunity. Buying into NIO at sub-$6 levels is essentially betting that the company can continue executing on its growth strategy and that, over time, the market will reward that execution with a higher valuation. For traders, the focus will be on whether NIO can quickly reclaim the $6 level and turn it back into support, or whether it consolidates lower before making another push higher. The takeaway is this: NIO remains a story of cautious optimism. Yes, there are risks, competition, pricing pressure, and macro headwinds, but there are also undeniable signs of progress. Record deliveries, incremental financial improvements, and a unique strategic edge in battery swapping all point to a company that's still fighting, still innovating, and still growing. Friday's close below $6 doesn't erase that progress. It simply sets the stage for the next chapter in what has always been a volatile, high-stakes story. As we head into the weekend, the angle I'd emphasize is this: NIO's fundamentals are strong, the growth trajectory is intact, and while the stock may be wobbling, the bigger picture remains bullish. The question isn't whether NIO can bounce back above $6, it's how quickly it can do so, and what catalysts will drive that recovery. If you're looking at this name through a long-term lens, the dip below 6 might look less like a red flag and more like a reset. As always, remember this is not financial advice. Do your own research, weigh the risks carefully, and make decisions based on your personal strategy. But from where things stand, NIO continues to be one of the most fascinating EV stories in the market today, an underdog with real potential, facing real challenges, but still very much in the fight.